please join me in welcoming Catalina Valentino, the Group CEO of ELIXR, Giovanni Terranova, the Managing Partner and Co-Founder of Bluefield Partners, Elena Mariotti, the Managing Director of Cerberus Capital Management, and Mark Watts, who's a partner at LCP.
Hello, everybody. Good morning. Hope you've had enough breakfast out there. It all looks lovely. It's my pleasure to introduce the next panel, the first panel of the day, which is all about clean tech and transition with energy, investment, etc. And before we get started with the panel, it would be great to hear from the panelists themselves, a little introduction on what it is that you do and why you're on the panel today.
Good morning, all. I'm Giovanni Terranova, one of the founding partners and a managing partner of Bluefield. Bluefield has been in the energy transition for the last 15 years. We currently manage around 2.3 billion of assets in renewable energy particularly. And we are not only a fund manager, but we are a fully integrated group, which means that we have also development of the renewable assets. We have a construction management, we have the asset management, the technical asset management, engineering, and operations. So we are fully integrated, and we are therefore not only a fund manager, but also a developer and operator. We have around 1.3 gigawatt of assets, renewable assets, solar, wind, and battery storage, mostly in the UK and Europe. We are very much focused on the European markets. And as I said, we've been around for the last, as Bluefield, the last 15 years, so we've seen a lot of changes in the energy transition.
Hi, everybody. I'm Elena Mariotti. I work at Cerberus Capital Management, which is a multi-strategy asset manager with 60 billion of assets under management globally across multiple sectors, including also renewable energy from development stage and beyond. My role, I'm a managing director, and I'm the head of sustainability, stewardship, and decarbonization, which essentially means that I work with the management of our portfolio companies and assets to create a transition strategy which has a positive impact in the bottom line and also makes the company ready for the transition economy, which is where we are now and where we will be going forward. Before then, I was in Blackstone, where I ran the portfolio-wide decarbonization program. And prior to that, I spent 5 years in management consulting in the energy sector. And prior to that, 5 years as an engineer. I actually started my career working on oil rigs in the North Sea, and then I worked on renewable energy plants. So I joke saying that I've actually done the transition myself from oil and gas to renewable energy. So it's good to see both sides of the spectrum in the energy sector. So thank you. Over to me.
Excellent. Thanks, Elena. It's good to see somebody who's done the transition has actually achieved net zero from a career point of view, which is great. So my name is Mark Watts. I'm a partner in the investment team at LCP. So for those of you who don't know us, we are primarily, as far as we're concerned here, an investment consultant. But what a lot of people don't know is we have 120 energy transition experts. So some of you may have worked with us before under the auspices of LCP Delta. So that particular business has been advising governments like the UK government for the last 20 years on energy policy, but we also do everything from advising energy system operators right the way down to asset managers when they buy and sell assets. So on my side of the fence, we advise asset owners, so it could be sovereign wealth funds, central banks, pension funds. We advise them on asset allocation, and one big theme that we're keen on at the moment is the energy transition. We do think that is a multi-decade theme, so this is not, and we'll talk about this in a minute, but this is not a flash in a pan. So what we're using is the insights of that energy team to drive where we think it's appropriate for investors to invest, and more importantly, where maybe isn't quite ready and what to avoid. So my background is asset management, so I've been running money since the late 80s. I have spent time running money in London, New York, it was Boston actually, apologies, shouldn't get that one wrong, and also in Abu Dhabi, where I spent 4 years running National Bank of Abu Dhabi and then back in the UK running Gulf International Bank. So quite an affinity with the GCC. I'm qualified in Islamic finance if anybody wants to pick me up on that, but happy to answer any questions at the end.
Excellent. I think that just leaves me then. So I'm Catalina. I am the Group CEO of ELIXR. ELIXR is essentially focused on smart cities and smart regeneration. So we have a number of companies which address different challenges, whether that be looking at retrofits and how we can improve our existing buildings, or if we're looking at new assets, for example, we have a technology which enables sort of smart planning with digital twins. And then we also have an energy systems company as well, which focuses on IoT. We install sensors into a building, and that, obviously monitors the asset and obviously saves costs as well. We have a 30-town smart regeneration framework with AECOM and Pinsent Masons, which is looking at underdeveloped regions in the UK and how we can enable them to grow economically, also with regeneration and infrastructure, and how we can do so with a series of different technologies and companies and partners. So I think that brings us up to speed with the panelists today, and let's dive straight in. So, over the last few years, net zero and energy transition has been on everybody's lips. But more recently, we've seen a rise in popularity globally and a lot of rowing back in commitments. So, my fellow panelists, do you think we're seeing choppy waters, or is the tide going out on the energy transition? Mark, I'd like to hand it over to you first.
Sure, I'll start with that one then, because it is very much a hot topic, and I was thinking actually on the way in whether I should do an impression of Donald Trump. So I did actually look it up on YouTube, and unfortunately you're not going to get the impression because I am atrocious. But it's that comment and that phrase where he basically said, this is a national economic emergency and we're going to drill, baby, drill. And so you can definitely see the headlines. That probably typifies the global rollback we've seen in the last couple of years. Largely populist driven, so from the ground up, people may be thinking things are going a little bit too fast. Maybe there's a sort of a coinciding of in Europe, much more expensive energy, and people are looking for a scapegoat, and I think renewables are that scapegoat. So you've seen President Trump withdraw from the Paris Agreement. You've seen him pull back, or trying to pull back, from various parts of the Inflation Reduction Act, or IRA. And that momentum, I think, has been picked up certainly in some populist parties in Europe. We've seen in the UK here specifically. I think Rishi Sunak started by rowing back on a few commitments. We know that the Reform Party isn't wholly behind renewables. We've seen the rise of the AFD in Germany, so polling, I think, on average around 20%. But again, one of their pillars is to stand against renewable energy. So there is very much a political, almost picking up on the populist sentiment to maybe not go as fast as they were before. But there is a big but, and this is where I think we're getting choppy waters versus the tide going out. I think the important thing to note is underneath all of that, things are still happening irrespective of national policies. So a couple of things to maybe highlight. I think economics are definitely king. So utility scale solar costs have decreased by 85% since roughly 2010. Pretty similar, but not quite as large numbers on onshore wind. Quite simply, in many countries, it is cheaper to put in renewables than it is to reinvest or invest in new gas and new oil. So those economics are actually driving that longer-term trend. And if you look below the line, I think 77% of all renewables that were put in the States were put in Republican, traditionally red states. So irrespective of what's happening on the top line, and that's what we see on the headlines, it is just happening at lower levels, day in, day out. So I've got a couple of stats to throw out there. Texas, which we would all think is a classic drilling state. And in fact, they are drilling. Of course they're drilling. And yes, they will be drilling more because of the things that Trump has said. But they've actually put in 42 gigawatts of wind, 22 gigawatts of solar, 6.5 gigawatts of battery storage. That stuff all needs investment. What they did a few years ago is they've liberalized their market, so you can actually get grid connections, you can trade. They put a lot of money into their networks from 2010 onwards, so you can move that energy around the system. So the infrastructure has had the investment, and now you're reaping the benefits in terms of that generation capacity. So I would say, yeah, top line, it does look like it's a bit choppy out there, but actually bottom line, it's still happening organically.
If I can add just something, I fully agree with Mark that like actually under the radar things are still happening despite policies. And on top of this, I believe personally that policies will swing on the other side again, because to get to the 1.5 degrees scenario, which is where we need to be, we are not there. With the current policies, we are not there. There is too much gap in terms of current policies between where we are and where we need to be to get to that scenario. So I believe that also over time, it's like a pendulum. Now we are on one extreme of the pendulum, and over time we'll get back to where we need to be in terms of policies as well.
If I can add, in a way, I would say, complementing what Elena and Mark said, it was kind of expected that it would have happened, and the reason being the first 15 years of the energy transition, we have been reaping the low-hanging fruits, so the easy part of the energy transition, so the generation, so we went through from 0 to 40, 50% of generation to renewables, easier part. Now in the second kind of era of the energy transition is the hardest one, because we need to go into energy efficiency, electrification of heat, electrification of transport, and and the final bit of the generation, which will go from the 50 to 80, 90% of renewables, which is the hardest part. So the choppy waters is not kind of unexpected in a way to see that, and seeing a bit of a backlash. Despite that, I mean, 2024, Bloomberg data, more than 2 trillion of investments in energy transition, of which 1 trillion for the first time in renewable energy. So very, very significant numbers. It is true that a big portion is China, that has been doing almost 40, 50% of that amount, but it's a really significant milestone. 2025 probably will see similar numbers. We have to wait and see. So the energy transition is here to stay. Yes, choppy waters, but as Mark was saying, I would add some more reasons why I think it's unstoppable now. There is a number of areas why the energy transition now is sort of unstoppable. One is the cost, what you said, I mean, affordability. All governments, right, left, or whatever color they are, they are very careful in managing the cost of energy. And solar, wind, as Mark said, they are tremendously kind of more cheap than many other energy sources, so affordability. But particularly for what concerns Europe and other countries, but particularly Europe, the security. I mean, the 2022 Ukraine crisis has shown something that relying on external gas supplies is kind of not the best choice. You have to diversify, and relying on domestic energy sources is important. So solar and wind will tick the box. And also the decarbonization obviously still remains an important target, and is not a chance by which Europe still, despite the recent elections, is still continuing, particularly European Commission, still having a green agenda. So there are choppy waters, but it's kind of unstoppable, and the last reason why it's unstoppable, because there are from the technological point of view, they are superior technologies. I mean, electric cars are more efficient, solar and wind are cheaper. So there are good reasons to believe that the energy transition will continue to remain a very interesting investment theme. We have to navigate, of course, through choppy waters and probably change a bit also the way we approach, because it's true. The last thing is that the public opinion is slightly turning a bit more kind of dubious, but still in minority. But because the energy transition so far has not, and we in the industry have not been very good at communicating the benefits and sharing these benefits with the communities, with the local communities. So we have to improve on that bit, but we'll continue. I mean, energy transition is here to stay. It's a macro trend, unstoppable.
Yeah, well, I mean, I agree. Like you said, we need to be selling the benefits more, cheaper energy bills, better communities, better assets, and, our health, there's less mold, all this other stuff that we don't talk about enough. It's the benefits. So I think that we all agree that the energy transition is here to stay. How have investors' appetite for the energy transition and renewable energy markets changed over time? And how might it change leading up to 2030 and 2050 agendas? Giovanni, I'll hand back to you.
Thank you. First of all, I've been in the industry for more than 20 years now, so I've seen a lot of changes, and particularly, let's say, the period between, excluding 2005 to 2008, all the remaining periods up to 2022, we have lived in an environment of low interest rates, very, very low, almost negative, and that meant that the energy transition was fueled particularly by the investors seeking yield, stable return, long term. So it was very much a game of focusing on yield, investing in asset, and whatever was able, whichever asset was able to deliver a yield was quite attractive. And that fueled very much the transition, the first wave, particularly in Europe. 2022, we have seen something that we've never seen before, or briefly interest rate so high, only maybe in the period 2005, 2007 were relatively high, but we've seen something completely new for the energy transition and for the entire economy with a higher interest rate. So what we have seen, and if everybody probably experienced that, the higher cost of capital, the investors, the LPs in funds are looking for higher returns, whereas before single digit worked very well. If you were delivering 7, 8, 9% was excellent. Now most of the LPs investing in energy transition looking for double-digit returns, simply because they can achieve a single digit with the debt instruments. So there's been a shift the last 2-3 years, really, from the yield focus, which is still there, but less of the interest, moving into the total return, so yield plus capital appreciation. And that has been a trend in the last 3 years, really. And there's been simultaneously also a move from investing in assets, investing into platforms, which can deliver this total return. So platform where you have not only the assets, but you have the development, and therefore investing in this platform, you have the yield, but you have also the growth opportunity that is bringing the total return. And lastly, what we have seen, and we have been one of the first to list a solar fund and a renewable fund on the London Stock Exchange back 13 years ago. There's been in the last few years, the public markets have been, particularly for this reason of the yield mostly, they've been less popular, let's say, than to the investors than in the past. And there's been a move more into the private capital. And with this move, clearly you have to pay a bit more the premium for the lack of liquidity that you have on the public market. So another trend has been more move from public to private. And by moving to the private, obviously there is a premium for the liquidity that you don't have, and so again, higher returns. So we are working into a quite different environment than we had 10, 15, or even 7, 8 years ago. We all have adapted, and we as a manager having this full integrated platform, we've been able very much to work through these changes.
Who would like to go next? Mark?
Sure. Yeah, it's interesting actually. We speak to asset owners, and the asset owners we advise have total assets of about 850 billion. So we've got quite a breadth of clients that range from very large down to some sort of smaller endowments and charities. And I think it depends where your size and where you come from in terms of your approach. So a large investor, let's look at the Australian super funds or the Maple 8, the Canadian large pension plans. Typically, these guys are investing direct. They don't need asset managers. They don't need any external advice. They have in-house teams. When you get down to the smaller, medium and smaller, the ability to actually execute in-house is much less. So you're reliant on external expertise, maybe advice, maybe managers. What we've actually found is that increasingly we're getting calls from clients to just explain, help educate them as to the technicals of the energy transition. I mean, I kind of unkindly say there's energy geek, which is a different language to investment geek. And what we're supposed to be doing is translating one language to the other. so that at least people understand the basics of what they're investing in. So we're seeing a lot more interest from our clients. Investors are recognizing now that it's not just a private equity stroke infra play, it's also private credit. So the portfolios we're building for clients on the private equity side are, give or take, around 12% IRRs net of fees. On the private credit side, given that we've had a shift in rates, we're getting to around 9%. So we're getting a number of investors who are saying, I don't mind taking the illiquidity premium because maybe I am a long-term investor and I'm in the UK example, I'm running on. I'm happy to take that illiquidity premium. I don't need the growth assets. So I think that there's definitely two sides of this energy transition. It's not all about private equity. It's also about private credit. So we are seeing that groundswell of investor interest. And don't forget, just because nation states are rolling back, and we have seen the odd corporate roll back a bit, but generally speaking, corporates are far more behind the energy transition and net zero targets than some of the more populist governments. So again, there is that groundswell of activity that...
Maybe private debt is very interesting because indeed what happened when interest rates were very low, private debt was not an option. And now indeed, when you go and fundraise for energy transition equity, you bump into a lot of LPs that they say, okay, well, I have the option of private debt that is like 8, 9%. So it's pushing clearly the equity returns higher up. Yep. But if you look on the side of developer, as we also are, that actually private debt is quite useful because it fills a gap that there was in the market. The traditional banking system providing senior project finance, they've been like relatively kind of boring standard products. But with the private debt, with the private funds, then they are covering a part of the market, like the mezzanine, the juniors, the preferred equity. They are covering the development, the merchant risk that banks normally were not that. So as a developer, you have now a wider range of debt options, not only the bank debt, but the private debt, which makes your kind of ability to finance your project easier. So there is some kind of positive coming out of that, of the kind of the rise of private debt.
Yeah, and maybe give a couple of live examples here. Now, we're seeing managers whose whole ethos is to provide effectively bridge financing. So a project that's just come out of development construction phase and is going into operating, the financing changes, you require a bridge for that period. Now, that could be 12 months, it could be 18 months. But there are funds out there that are just regularly extending that bridging debt. Weighted average life really quite short, but actually quite attractive yields. And then at the other end of the spectrum, so let's say at the bottom on the demand side of the energy transition, you're seeing companies who are now starting to securitize the receivables of rooftop solar in Europe. So think of that as sort of akin to ABS. So that allows all of that exposure to be lifted off of a company's balance sheet, and actually quite high quality. Those consumers that are typically putting in rooftop solar are high quality consumers with very, very low default rates. And so again, that's really attractive because you're freeing up the balance sheet for that company to go and install another 100,000 or 10,000 or whatever the number is, rooftop solar. So actually, debt is really additive to the system. You're facilitating the next wave of installation. So yeah, I think we're quite keen. Probably worth saying though, it's really difficult to find private debt managers. We spent a lot of time finding those managers globally. They don't seem to come up on the radar as much or as easily as you would find Bluefield or Ares. They're a lot more difficult to source. So if anybody is interested in that area, happy to chat afterwards.
Excellent. So thank you both for those examples. It seems that the investor preference does seem to change over time. How have managers responded to this in terms of how they can undertake their deal diligence and creation of value, especially given the focus on sustainability that many investors are now expected to have? Elena, I'd like to come to you first.
Yeah, thank you. So especially given these, some states or investors are more pro ESG, others less, or transition in general, because I think the word ESG is very misleading. So the way we do it, and we've always done this way, is we use a financial materiality approach, both in diligence and after diligence. What does it mean? It means that we look across the company value chain and we focus on the few sustainability issues that can be material for the company bottom line. So to give you an example, and the difference is that in diligence, we focus more on the risk mitigation part, so value protection, and then after diligence, in the first 100 days and beyond, we still focus on the risk mitigation, of course, but we also focus on top of that on the value creation. So to give you some examples, in diligence, if we look at, for example, a solar project, we want to assess the risk in the value chain. So, for example, we want to assess if there is any forced labor or things like or what is the level of embedded carbon in the solar panel. Other things can be, for example, if we look at batteries for storage, for energy storage, we also want to look and assess the life cycle assessment to really see if the energy emissions in the full life of that battery is really like lower as is supposed to be and not higher than you're not using the battery storage. So these are some examples in the diligence side. Then when we move in the ownership phase, we look at this from different angles depending on what the asset is, but considering the value creation element, one example could be new revenue streams. So for example, with a company, we've looked at innovating their materials so that now they are producing they're manufacturing something which is fully circular. So whatever they manufacture now is made with recycled material, and it is also recyclable. And this is an additional revenue stream which they didn't have before, and their clients, because we've done this materiality assessment, we have seen that some of their key clients were really keen to get this kind of product that also gets sold at a premium. So this is an example of new revenue stream. Another example is social acceptance, which actually has an impact in the bottom line, because when we do some projects which have an impact on the local communities, it can be a solar project or different kind of projects, it's really critical to get approval from the local communities as early as possible, and lack of that approval can not only delay the project, which therefore means that you're losing money, in some cases it can even stop the project. So there are what is basically financially material, and we do with our portfolio companies is strategic stakeholder engagement with local communities on one end, and on the other end it's also technology innovation, because we work with our portfolio companies to innovate the technologies that they're going to use and deploy in that land, so that it can minimize the impact in the environment. And that also can help accelerate approval and deployment of these technologies, and has a meaningful impact in the bottom line. And the third and last example is accessibility. So deploying renewable energy to bring power to areas that would not be otherwise sourced by the traditional grid. So these are a few examples of what we mean when we say we focus on financial materiality, when we look at how we can add value or protect value, whether it's in diligence or after diligence. And now it's even more critical because, as I said, given there is this pro and against, at least this is an objective way to show that the energy transition can really create and protect value.
Do either of you have anything to add, or should we go to the next question?
Just only I was reflecting when Elena was talking. If you look back 6-7 years ago, we have no one working in the sustainability ESG department. Now there are 5 people working, and I think what we discussed before, even if there is a rollback into kind of particularly US into ESG sustainability, but this kind of area is here to stay again, because it make from the social side, the sharing the benefit, that is crucial, and it will happen regardless of regulation or not. There are areas that we want to do, for example, as an operator, investor in renewable energy, we are spending a lot of time and repowering old assets, and so one area which we are looking at, how we can create the circularity of the equipment you remove, and then how you can extract the maximum value out of those. So there are reasons why the sustainability angle, the ESG, will remain, despite whether it's fueled by regulation or not.
I think Elena also made a really good point about how everybody thinks of sustainability as just being almost philanthropic, and we should be looking at this to be more economically driven, because there can be other value chains, creation, revenue streams. I mean, if you look at some of the things that we could be doing from a local authority perspective, or even development, you know, if we could add in things like micro data centers or other things like this, microgrids, these things could provide, you know, millions of revenue every year, and it creates this new value chain, but also has local, you know, input and impact. So I think you're completely right on that. We need to be thinking about this as an economic activity. So pulling together what we've discussed so far, and I appreciate you've given some fantastic live examples so far, we've seen a shift away from subsidy-led revenue models to greater reliance on merchant markets. How is the move away from subsidies reshaping the landscape of energy transition investments? Giovanni, Elena, whoever would like to go first.
That's okay. Clearly, I mean, there is this shift, and if you look pre-2022, it seemed quite clear that the incentives that have fueled the renewable energy wave, particularly in Europe, back 15 years, were about to disappear completely. And everybody was preparing for the merchant world, which is the natural way the market should go. After 2022, again, particularly Europe, which is the market we know better, of course, what happened is that with the energy crisis, the particular European Commission, but also UK, looked at the renewables as a solution to the energy crisis. And I said before, a solution for affordability, for security of supply, for decarbonization. So it was recommended, for example, from the European Commission in 2022, to come up with further wave of subsidies. This time, subsidies were not supporting were the lifeline for the renewables, because back 15 years ago, without subsidies, renewables could not stand on their feet. But this time, seen as a way to hedge against the volatility of the power markets, or the energy markets. So still, there are still a number of countries, quite important countries, UK, Italy, France, Germany, Poland, Romania, there are quite a few in Europe that have still incentives, long-term tariffs, CFDs for renewable energy. And that makes this transition a bit more complex to merchant, because what they do, and it's more, I don't want to be super technical, but basically if you look at the energy at the power market, and you have a bunch of assets, a big bunch of assets that are all subsidized and fixed, they inject electricity into the grid regardless, and they enter the market at so-called marginal price zero. The power market is still a marginal price driven, so what happens is that the assets that are in the other group, the merchant one, they suffer because they have an entrance in the market at zero, which pushes down further down the power price. So the government have been a bit unsure what direction go, and they really need to take a decision whether if they want to go and decoupling the renewables from the rest of the market, they need to continue with the incentives. But if they do this mixed approach, they create a bit of further volatility in a way in the merchant market. So I'm pretty sure that this will come clear in the next few years, and the governments will need to take a kind of a clear decision. Because the natural way probably is to go into in the more merchant area. And so we'll see. I mean, we have done a number of projects in merchant, and likewise also in tariffs. And there are ways that we can discuss later. You can work very well with the merchant by hybridization with batteries particularly. So there are ways, but the governments have not been very clear, and the European Commission has been a bit undecided, by UK as well. I mean, there are a lot of CFDs still around.
Excellent. Elena, do you want to add anything?
Giovanni did a great job already. I guess the only thing I would add is that, in general, when we look at projects, we look at different scenarios, or also with or without incentives, to really see if we think it makes sense under different scenarios. So that's also an additional layer that we use to basically manage risk.
Well, I guess from our point of view, we have the luxury of being able to listen to these stories and sort of sort out the good stories from the not so good stories, which is great because both of these are good stories. From our point of view, taking it beyond the merchant risk argument. We don't necessarily have to take the merchant risk if we don't feel that that's appropriate. What we have been looking and seeing in the market increasingly is opportunities in the corporate PPA space. So this is effectively taking it out of that whole argument of is it subsidized, should it be, etc., and putting it into that whole world of, well, look, these large corporates, so let's call them hyperscalers as great examples, so the Amazons, Microsoft, Googles of this world, they are putting in and procuring more and more generating capacity each year. So some of the stats I've managed to grab is 200 gigawatts of generation capacity has been procured since 2005. That's the same as the generating capacity of France and the UK combined. Amazon, every single year, procures the same amount of generating capacity as Belgium. So these are opportunities, I think, that investors can't afford to miss. So these would be opportunities to invest in maybe solar and battery arrays that effectively are co-located next to maybe data centers with a 15-year PPA. And often these corporates are paying really good money, considering the cost of production, to actually just secure that 100% load. So they really, really want to see renewable energies. They have those corporate targets to hit, and they want to actually procure this just for themselves. So this is throwing up a lot of opportunity for us. So even where in the US you may think that things are stalling in some areas, there are other areas that are actually almost picking up the slack from an investment point of view. So from our point of view, it's really good to see that the grassroots deal analysis is being done, but actually we have the option to sort of skip around and work out where those bigger opportunities are lying. And I think don't ignore the corporate PPA space.
Well, thank you very much for that, Mark. I'd like to come to each of you just for some closing remarks, just to see how we can summarize, the panel discussion we've had today, any sort of actionable insights that the audience can take away from today. Let's start with you, Giovanni.
Well, I think that the main theme of our starting panel today has been a conclusion, I think, that we are in choppy waters, but the energy transition is here to stay, and it's here to stay because of economic grounds and decarbonization reasons, and it's here to stay. And it remains really an attractive opportunity for investors with interesting double-digit returns in equity, single-digit returns in credit or in private debt. So it's a macro trend that is here to stay, and we will talk, in the next 10, 15 years, we'll still have panels talking about energy transition because it's something that is unstoppable now.
I would say, I echo Giovanni, I guess for me, two things. Definitely energy transition is here to stay, and this is a fact in my view. But also on top of this, as Giovanni said, it offers some meaningful returns, and then from an operation standpoint, once we have these assets and we operate these assets, it's really clear that energy transition offers real opportunities to enhance the bottom line of these companies, as I mentioned earlier, through this financial materiality approach. So there are really several angles from the acquisition to the operation aspect that really show how the energy transition has clear value to the bottom line.
And I'd say from my point of view, let's go beyond renewable generation. We're very, very keen on the whole ethos of the energy transition only works if it's a whole of system solution. So yes, we can generate it, but if we've got too much of it, we need to store it somewhere. If it's being generated in one place, it needs to move to another place, maybe for where the consumption is. So the UK is a great example. Lots of production in the north, lots of demand in the south. And then we have the demand side, which we've touched on. So you've got to be able to invest in the infrastructure, the network. You've got to also invest in those storage solutions. And you also need to invest in decarbonisation of heat, transport, and industry. And the opportunities there, I think, we're in the foothills of those. We're seeing a lot of good opportunities there. And think of it as investing in picks and shovels, not the mines. So if you think of generation as the mines, of course they are investable. but also think about the picks and shovels, the things that you need to facilitate that. And that's where we're seeing some fantastic opportunities. So I would just encourage everybody to make sure you're broad in your approach.
Thank you, Mark, and thank you all. I think that wraps up our panel for today. Thanks all.